Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Long Verticals and Diagonals. And today I want to do a side-by-side comparison. Are long calls a serviceable replacement for stock investing? Well, there can be pros and cons to that. We're going to be talking about trading long call diagonal spreads for leveraged upside potential, but we need to weigh the potential cons as well. We'll be placing an example trade. Should be a really interesting discussion. Before we get to it, though, let me first of all say hello to everybody who's chatting in out there in YouTube already. Great to see so many familiar names, as always. Hello there, Janelle and Joe, Life in the Fast Lane, Hope, Will, Sharon, Frank, Greg, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, we'll enjoy the recording, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series, and we kick things off promptly at 11 Eastern time. We'd love to have you here in a live audience. And as a treat here for my live audience members, my very good friend Brent Moores is hanging out in the chats. Brent and I have worked together for a couple of decades now. Brent's going to be addressing any questions that I can't get to that come into the chat during the flow of the presentation. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters there. It's the best place to connect with us when the cameras aren't on. You can find Brent on X at Brent Moore CS. You can find me on X at Cameron May CS. But let's get into this discussion of options versus stock ownership. All right. Now, as we do this, of course, there are going to be risks involved. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. So let's set an agenda for the day, right? First thing that we're going to do, since this webcast or this video is part of an ongoing series, we're going to go have a look at our existing positions in our paper money portfolio. I think there's one that needs some special attention today, so we're going to look at all three. Then we're going to look at the markets to set sort of a backdrop for this discussion of buying options in place of stock as sort of a stock replacement strategy. So we're going to be doing a long call vertical spread, but as we do it, I want to outline three big potential pros of options versus stocks, but also three big risk considerations, options versus stock. But then we're going to place an example trade by the end of the discussion. All right, so let's get into it. Let's go right to Thinkorswim. This is the Thinkorswim desktop software that can be downloaded free of charge from within your Schwab Online account. You just pop up the Trade tab and look for Thinkorswim. That's where it can be downloaded. But right now, in our long verticals and diagonals portfolio, we have three positions. We have Gilead, we have Alphabet, and we have NVIDIA. So with Gilead, this is a long call diagonal spread. Good, it's a topic for the day. We, a long time ago, bought some $95 calls, and those have been doing just fine. Bought those for $16. They're right now trading around 26, up about $10 per share, or per share there. Sold recently a 120 short call. Sold that for a 142 premium. That premium is coming down, which is what the trader might hope for, worth 97 cents right now. But that's only part of the story for Gilead since we first bought those long calls. Those were first purchased right at the end of January. And you can see since then it's been an up and down ride, but more up than down. Those long calls have been doing pretty well over time. But in the short term, against that long position, we've been selling short calls. We got off kind of a rough start. Took a couple of losses here as the stock absolutely blasted out of the gates. But then as it settled in, since then, we've sold some short calls for profit, and we'll see how this one goes. So far, it is profitable, but unrealized. Now, when might the trader just decide to say, well, this has been a fun run, but time to take the profits and run? Well, for some, they keep an eye on the trend. And if you'll notice, very recently, we hit a high here back in August, pulled down to a low, raced up to a new high but it didn't reach the previous highs. So we have a new lower high. And now that we're pushing back down, we're kind of challenging those previous lows. So for some trend-oriented traders, if we break down below that low, maybe that's time to be done with this very bullish strategy overall. So we're going to consider exiting if that support breaks. We could put in an order to just do exactly that. I'm not going to do that because I want to talk it through if that event transpires in a future webcast. But for now, we'll keep our eye on that. I'm going to leave this note here that I've added. Sia says, did we happen to put a stop loss on it? We could. I'm not going to, Sia, but that is possible. Yep. For now, we're just going to keep our eye on that 110 level. If we break down below that, we'll talk about exiting. All right. But the Gilead doing just fine. Going on to Alphabet. This is another long call diagonal spread. Bought the 16th of January 2026 calls. Bought those for 25 bucks. They're worth 75 bucks. That's a $50 unrealized gain on those long calls. And right now, we're in a short call. Sold it for 350. It's worth 36.50. We're looking at a $33 unrealized loss. That is definitely putting a drag on the performance of the long call, but overall, still a profitable trade. And as a matter of fact, we've made a little tiny previous profit in this one as well. So let's have a look at that. So look at Google, GOOGL. Bought our long call back here, sold an initial short call, the 205 call. We closed that out for a very small profit, 26 cents per share, $26 minus a commission, left us with about 25 bucks. Then we rolled that up to 215, and this stock is absolutely blasted through this. And as we're approaching tomorrow's expiration, this thing is way, way, way in the money. Is there some tiny chance the stock could reverse and come back down below our short call and help us avoid assignment? There's a tiny chance. Almost no chance, though. Also, would the trader actually want that to happen? Because if we reverse back down below 215, that would help us with a short call, but it would absolutely clobber the long call. So what should we do here? Well, trader could wait. Now, in paper money, we're never assigned early. It just doesn't happen in paper money. It can certainly happen in real money, in a real portfolio. And as we get closer to the expiration and as we go further in the money, that raises and raises and raises that early assignment risk. So yeah, this is a really good illustration of the combination of those two factors. Really high, comparatively speaking, risk of early assignment. KC says you're beginning to enjoy long trades versus short, limiting the losses. Interesting. We're going to be talking about those pros and cons here. So a nice little setting the stage sort of a statement. But would there be necessarily anything wrong with this trader? Hey, I've made 50 bucks here. I'm underwater $33. That's, according to my math, that's about a $17 net profit to add to the 26 cents that we already cashed in. Is that a bad trade? Maybe we just wrap this up. 17 bucks a share times 200 shares, a $3,400 profit. This whole trade didn't cost us more than about $2,400. That's a pretty good return. Actually, it was $2,400 times two, about $4,800 trade. Or maybe the trader could do this. Maybe instead of exiting, they buy out of this short call, okay, taking the $33 loss that we're looking at, but that frees us up, and then maybe we sell another call somewhere above this. Could we sell maybe the 260? So if we get a reversal in price before that October 17th expiration, maybe that premium could absorb some of the bumpiness for the long call if we decide to stick with that. How about we do a combination of both of those? I'm going to go here to our monitor tab. Let's right-click on Google. Let's create a closing order to sell out of our diagonal spread, but I'm just going to exit one of these. That would be for about a $39.15 credit, remembering we paid about $24. What was the original credit? I can't remember, but it was in that neighborhood. So that would be realizing a gain if we're able to exit let's see, with our mid around 39, our natural around 38.65. Let's say that we're willing to accept a 38. Yeah, let's go for 38.80, sort of right in the middle. Trying to dial up the likelihood of a quick fill. But let's click confirm and send. And we're going to sell out of, pardon me, just a second. But we're going to sell out of one of these contracts. There is a commission here on the long and on the short, total of $1.30. But let's send this order off. And let's see if we can get a quick fill as we go to our working orders. We can see, ooh, I'm demanding a 38.80 credit. Right now, the market's 38.85. That's, I might be asking a little bit. We'll see. There's a good chance this will fill here pretty quickly. But while that's working, let's talk about what to do with the other contract. Because we're still looking assignments square in the face of this short, of the remaining short option. So what if we were to roll that one up? Well, here's what rolling means. It means we're going to buy out of the one that we're currently in. It's going to cost us probably $33 more than we received for it initially. 33 bucks realized loss. Ouch. But that frees up this long call. That is, we're out of the one, so that leaves us with one. But it frees up the profits that we've made on this short call, the unrealized profits. Now, those can evaporate if the stock reverses course. But I think what we're going to do here, let's see if we can roll up a little higher. Maybe we can roll up to 260. Let's go see what we can maybe get for the 260, 17th of October. 17th of October, 260. All right, that looks like around $5. Could we go up a little bit further? Go for 265. That would be about a 30 delta, about a 30% probability of expiring in the money, a 70% probability of seeing this expire out of the money, collecting and retaining the 380-ish. Bruce says you don't roll short options. Bruce, that's an absolute statement. I don't actually discuss absolutes in this webcast as a matter of managing or even entering trades, because there are pros and cons to each approach, right? Rolling this, I know that some people say, hey, you got to roll for a credit. Guys, how in the heck would we roll for a credit here? We'd have to either go way in the money or we'd have to go way out in time. So for those who say you always roll for a credit, sometimes that's not on the table. In this case, we've just about realized a loss. There is nothing we can do about that. I know that sometimes rolling is discussed as sort of patching up a trade, it's repairing or salvaging or saving a trade. It does none of the above. All it does is it moves the trade. Well, it realizes a gain or a loss, and then puts on a new trade, and then hopefully that new trade does better than any that have just recently lost money. But that's what we're going to be doing here. Let's how about we roll up this to the 265 strike. So on our chart, that's going to be up here. Let's draw in a line up here at 265 above today, right there. Carry that out to October. That's our new obligation and our new expiration. So let's go to our monitor tab, and we're going to go to that 215 strike. Right click on that and create a rolling order. So this brings up an order to buy back the 215 for the 19th of September that we are currently in. And let's go out to the 17th of October, and let's see if we can sell that. Okay, there's something wrong here. It wasn't the 215. That's okay. See, I get ahead of myself. This is where understanding what you're doing can actually give you insights into mistakes that you're about to make. There was no way this should have been a credit. Well, what had happened here is I hadn't moved the strike yet. So let's move that strike up to 265. I moved the date. Let's move the strike up to 265. Yeah, that's definitely going to be a debit. Sorry, that's the way it is. We are looking at an unrealized loss of $33. And there's nothing that trader can actively do about that loss. They can sit there and cross their fingers and hope that it disappears overnight while taking on considerable assignment risk, or maybe we could just wrap up the whole position like we did the other contract. In this case, we're going to sell a new contract. But this is going to be the fattest loss we've ever had to put on our chart. It's going to pair up with one of the biggest gains we've had, so that's okay. But let's put in this trade. Okay, right now 32. Let's say we're willing to go even all the way to the natural to get this order executed. So let's click confirm and send. Going to sell out of this diagonal. Well, we're not going to sell the diagonal. What we're doing here is buying back the one that we're in, selling another one further out and higher up. It's going to cost us some money plus a commission. Let's send that order off. There we go. So what we just did is we sidestepped assignment, either early or tomorrow, almost certainly. Boy, it would have been unusual to not get assigned under these circumstances. Sia says, can you merely roll the short leg of this vertical? It's exactly what we just did, Sia. So here's what we've done. Out of that 215 into a 265 for the 17th of October, and we're still in our 16th of January 2026. So we're still looking at an unrealized gain here. We did just take some big lumps on that 215. Well, sorry. At this point, what's the phrase? Water under the bridge. It's something that happens. Losses are part of the experience of trading options. So let me change this to a red line. That just shows short. Doesn't mean bad. It just means we sold something. And that's it for that position. Now, finally, we have our NVIDIA trade from, I think this was when was this? This was last week's trade. That's right. All right. So in this case, it was a long call vertical spread. Bought the 160s, sold the 165s. Here we prefer for the stock to be above 165 as we move toward the 17th of October. Right now we're at 176. We're down a little bit on the trade. That's because the stock it's not as far above 165 as it was last week. So let's go to NVIDIA. So here's our current position. Bought the 160 calls, sold the 165s. We prefer to be up here. We were up here last week. We actually came down, and we're moving back closer to where we were. This really, for this trader, may not matter much. As long as we're above 165 and we move toward expiration, the risk of early assignment is lower. It's not nothing, but it's lower. And we're in position for maximum gain if we can just get that toward expiration. Bruce says, why would you buy back a long call instead of rolling the put side? So we didn't have a put side, Bruce, here. You mean the short side? So the logic there being, if we go back, and I don't mind discussing this because it's an interesting position to find ourselves in, with the stock just rocketing up, why in the world did I exit? Why did I get rid of the long position on that first exit? Well, maybe the trader thinks this thing has run up so far, it's likely to pull back, and that would be exposing unrealized gains on this long to downside risk, which always exists. So if they just think that this is about exhausted itself, maybe just take the profits all the way across the table. All right, good question, but let's go with NVIDIA. We're just going to let this continue to work. It's come down, it's gone back up, it's sort of net move sideways. It's doing okay, down $90. We'll let that continue to work. It's still in position where we'd like it to be. So, and it's a week closer to expiration. I'm going to chalk that up as a win. And let's move on to adding a new position to our portfolio. But I wanted to frame this within the idea of how some traders will use options as sort of a stock replacement strategy. And I can understand the logic of that, but we also need to discuss the potential disadvantages of that sort of an approach. So let's go to the markets and see what we're dealing with as far as a trading environment is concerned. And guess what? I don't know, is this the 50th time I've said this recently? Record highs. Yep. Trading right up near record highs. We've actually come down off session highs a little bit, but for a trader who's looking to trade either long verticals or long diagonals, if their conviction is that the stock market is likely to continue moving higher into the near future, maybe that might cause them to lean more toward trading bullishly. And our bullish trades have actually been a great approach for the last 6 months or so now. Now, this is not a guarantee that the markets are absolutely going to move higher. They can turn and go lower, and that can be a rough period for a bullish trader. But let's just say that our hypothetical would-be diagonal or vertical spread trader thinks, as they're planning out for, let's say, the next month, I think markets are more likely to continue going higher than to pull back. Okay, CS says a market correction happening very soon. Could, right? We talked in one of my recent webcasts, we talked about seasonal tendencies for the stock market and for the S&P 500, and specifically right at this time of year. From mid-September to mid-October, there's a bearish bias to the markets. Now, if we're looking out further than that, it's actually quite bullish. For the end of the year, quite bullish. But these next 3 or 4 weeks could be bumpy if they hold to historical tendencies. Now, obviously, each year is its own unique thing. But let's just say that our trader just thinks net more bullish potential than bearish. So let's do a bullish trade today. And my example trade that I'm going to be using today, we're going to be leaning away from all those stocks that have moved up so far already. And we're going to be going back to sort of our nemesis for the year of 2025. Worst trade of the year was on United Health. We got absolutely hammered on United Health, taking a bullish position back here and watching it just get hammered. You know, I was off on vacation during this period, bad timing. But what's happening just recently? Bruce says, what about assignment risk? Bruce, are you asking? There is no assignment risk on a long call, just so you know. There is no assignment risk. Because we own that call. We're the ones that decide whether it gets assigned. If you're talking about the short call, now that we've rolled it way out of the money, it's not way out, I guess that's kind of a squishy term, but out of the money with more time till expiration, assignment risk has been dramatically reduced. Still present, even on out of the money options, but yeah, not really a strong assignment risk at the moment. Risk of Google being called away is nominal right now. Still present, but not strong. Okay. Yeah, when you think about the long option, yeah, it's way in the money. Doesn't matter. That's our long option. We're not going to exercise it. In any case, with United Health, this is kind of interesting. Couple of interesting things going on to a technician here, among others. This view of the chart isn't the only way to see things. But United Health was making lower highs and lower lows, but then recently it's made sort of higher highs and higher lows. That in itself can be seen as a trend reversal, but what is this pattern where we have a dip down to a low here, run up to a high, dip down to a lower low, run up to a relatively similar high to this one and this one, down to a lower low that's similar to this one, and now we've broken up and accomplished a break of a near-term resistance. This is known as an inverted head and shoulders pattern or bullish head and shoulders pattern. Now, it doesn't guarantee the stock is moving higher, but for some technicians, they see that as a just confirmation of a trend reversal. Now, buried within that, the head itself is kind of interesting because if you'll notice, there was a gap right here. Let me zoom in. I'm going to zoom in right here. There's a gap down. Traders seem to be quite bearish. Stock ran down, kind of chopped sideways, popped back up, and then gapped up. So these two gaps kind of left these candles down here floating in space, isolated, as though they're on an island from the trend before and the trend after. This is actually known as a bullish island gap reversal. Interesting. I just recently posted on X about a similar pattern that was bearish. I don't know if you saw this on X. So if you're not following me on X, these are the sorts of discussions that we can have. Just a couple of days ago, I asked, hey, you technical traders, what is the name of this chart pattern? This is a island gap reversal. C was the correct answer. So congratulations to those that said C. Well, this is a bearish example, reversing from bullish to bearish. This is a bullish example, reversing from bearish to bullish. So let's say that our technical trader notes all of this and they think, well, maybe there's some upside here for United Health finally. Had a rough last year, unlike so many stocks out there. So that kind of puts it in a comparatively unusual position. Lots of upside potential, but not at or near all-time highs. So let's say that our trader thinks that this stock is about to go for a new run, maybe lasting for a year or two. If a stock has been coming down for a year, and if we subscribe to the concept that stocks go down faster than they rise, maybe this will go up for 2 years. That's a kind of a basic premise, but let's say that that's our trader's premise. So what they could do on that premise is buy some shares of stock, or maybe they pursue a stock replacement strategy, like buying a long call. All right, let me do a little comparison here. We'll just call it stock. Let's make it bold. Actually, let me put options first. Option versus stock, a comparison. All right. Well, there are pros to buying the option versus the stock, and there are conceptual cons. Let me just list those out, and then we'll talk about them in detail as we look at an example. So first pro is options tend to be cheaper than stock ownership, and they can be significantly cheaper, less expensive. Number two, there's a lower dollar amount at risk because of that lower cost. Number three, they deliver significant leverage when we're buying options. All right, so those are three things that might attract a trader to buying, let's say, a long call in place of stock ownership. There are some cons, though, that we need to consider as well. They have exposure to time decay. There is a higher percentage risk conceptually with option ownership versus stock ownership. And last but not finally, I was going to say finally, it's not finally, because some of you are going to think, yeah, Cameron, but you didn't make a comprehensive list of pros and cons. This is sort of an abbreviated risk, maybe hitting some highlights. True. All right. Bruce says, should all new positions be married? Now, Bruce, you've asked another good question, but what you'll hear me say over and over again is absolutes, like all, always, never. Those are terms that a trader should very likely try to shy away from, because there is usually not just one way to pursue a profit. There's not just one way to encounter a loss. And so we just need to weigh the pros and cons of each decision we're making on entry, on exit, on strategy selection, and then just tailor those decisions to an individual trader's own preferred, unique approach to the markets. So yeah, it's a good question, but all is a huge word. It would be inappropriate for me to say all traders under all conditions should do X, Y, or Z. All right. And by the way, I don't give advice anyway. All right. So let's compare buying an option to stock ownership. And so let's say that our trader thinks the stock is, at least they think it might go up for a year. All right, well, if we think the stock is going to go up for a year, and instead of buying the stock, we're going to buy an option, well, the last thing we'd want to see happen is the contract run out of time before the stock has realized all the potential that we see in it. So maybe the trader goes to the option chain. Let's stick with UNH, and let's go out far enough in time. Look at this. We could go out to, look at this. I didn't know there was one for exactly 365 days. Kind of pushing it, we'd be fighting a battle against time decay. This is what some traders will commonly do when they've selected a projected time frame for a trade and they're buying an option in place of stock. They will double the time frame they need for that trade. So that would be 730 days. 637 isn't going to do it. Let's go out to 820 days, 17th of December, 2027. And we are going to buy a call. Okay, so if we were to buy the stock at $341 per share, 100 shares would be about a $34,000 investment, $34,132.33 right at today's prices, right at this moment's prices. Well, instead of doing that, let's say that our trader is going to buy, how about we go a little bit in the money, Let's buy the $300 call. Now that's trading between 92.75 and 93.90. Let's sort of split the difference, and let's say that we buy the 17th of December, 2027, the $300 call. Let's say, it's moving a little bit. Let's say it costs us, by the way, you'll notice there can be quite a good spread, and that spread is kind of widening and narrowing. When we go way out in time, when we go deeper into money, that combination of factors can create wider spreads between the bid price and the ask price. And for some traders who are used to having very narrow spreads on the shorter term contracts, and maybe they're bringing that preference to the longer term, they might be in for a little bit of a sticker shock here. Yep, it might be several dollars wide on this spread. Let's split the difference here, about a $3 spread here, $3 between 92 and 95. Let's call it $93.50 that it costs us to get into this trade, maybe $93.60. All right. All right. So there's the call that we're contemplating buying. Now, is that an inexpensive call? I just suppose that depends on the trader's definition of inexpensive. But when compared to stock ownership, we're paying $93 per share, whereas with the stock, $341 per share. So we've slashed that cost by pretty close to 25%, or slashed it by 4 times, about 3.5, 4 times. So this is significantly cheaper. All right, does cheaper mean better? No, it means less expensive. Well, now, because we've tied up less money in this trade, when we purchase a long call option, that money represents the theoretical maximum amount that we can lose. Now, if we start messing around with the trade and we get in and get out several times, we're exposing ourselves to additional potential for more risk. Could lose over the course of several trades more money. Or if we allow this to get to expiration and we wind up buying the shares and the shares do something, that can introduce more risk. But and by the way, I kind of got stopped in my sentence because I saw a question I want to address. Anyway, the 93.60 represents the maximum that this trader can lose as long as it's exited before expiration. All right, so it's a cheaper trade, lower dollar risk, risking $93, $94 instead of $341. And it delivers significant leverage, potential advantage over stock position. I have to say potential because leverage can work both ways. That's why it exists under a pro and con. How much leverage is there on this trade? Well, if we bought this $300 call right now for $93.60, and the stock goes up $1, so $1 on the stock would be about 1/3%? $1 on a $341 stock is a pretty small move. This is a stock that can move pretty well within any given trading session. Well, that $1 move, if we look at our delta, among other things, delta can give us the probability of expiring in the money. It can also tell us how much the contract may make or lose on a $1 move on the stock. A 69-cent return, let's do this. 69-cent unrealized gain on a 93.60 investment is actually about 0.7%. It doesn't sound like a lot, but it's approximately double stock ownership. So this is a trade, the one that we've selected, that can make money twice as quickly as stock ownership, at least with the current trade scenario. Now, had we chosen a different strike, we might get even more leverage. But yeah, leverage is a potential pro. Going up just a fraction of a percentage point, about 1/3 of a percentage point on the stock, produces twice as much unrealized gain on the option. Awesome. Except that there also exist some potential cons here as well. What are those cons? Well, a stock, if we buy it, we can just sit on as long as we want. Yes, it's exposed to market risk, but there is not the element of time decay with stock ownership. There is with these contracts. We're paying right now $93.60 for a $41 discount on the current stock price. We can buy those shares for $300. Well, the shares are worth $341. I don't know, we have a $41 discount. But if we allow that to go all the way to expiration and the stock is still at $341, we still have the right to buy shares for a $41 discount, but it cost us $93 to do that. That $52 of additional expense is the time value of this contract. And as time goes by, that whittles away. That we have that exposure. All right. So that is not a fact when buying the stock. Now, another thing is a trader can get distracted by the fact, hey, I only have $9,300 at risk. That's just way better than risking $341. Well, maybe, but there's also a much higher probability of losing the entire investment or a significant portion of the investment with this contract versus the stock. Let me do some basic scenarios here to illustrate that. So let's compare. Let's say our stock trader buys shares. So that's trader A. They buy shares of stock. They pay $341 for those. Trader B buys the contract. They spend the $93.60, and then over the next couple of years, the stock goes up, the stock goes down. But at the end of those 2 years, we find ourselves exactly where we started, and the stock's at exactly $341. Well, our stock investor is bored, but they're not out any money. Matter of fact, they even collected some dividends along the way, which the option trader does not have the right to collect. But what's happened with our option investment? You think, oh, the stock didn't go anywhere. It hasn't done any damage. Yes, it has. That time value has evaporated. We've hit the end of our contract period, and we have the right to buy a $341 stock for $300. That contract's only worth $41. We spent $93 for it, so we'd have a $52.60 now realized loss. We lost half of our investment, more than half, just from the passage of time. It would take a big move on United Healthcare to lose half of its value, although take a look, it can happen, right? Now, finally, leverage works both ways. I said I wanted to lay out a couple of scenarios. The second scenario would be, what if the stock pulled down just a little bit? What if instead of going sideways, it just went down to $300 or went just below $300? Let's call it $299, and we get to expiration. Well, our stock owner says, ouch, I have an owie. I lost $42 on my stock investment. Lost about a little bit more than 10% on my investment. The contract trader now has the right to pay $300 for a $299 stock, and their time has run out. Their investment is worth zero. Lost 100% on a relatively minor move on the stock. So, yeah, there is a higher percentage risk. Lower dollar risk, yes, but a higher percentage risk. Now, finally, that leverage can work both ways. Going up $1 can produce a 69-cent unrealized gain. Going down $1 can produce a 69-cent or about a 0.73% unrealized loss. So there are pros and cons to using options in place of stock. But one thing some traders will do, buy the option at a lower price point and then sell calls against that long option. And that can actually increase the bottom line premium percent when compared to the investment. Let's do this. Let's buy this. Let's go to 300. Let's click on the ask price. And let's just buy one of these contracts. Now, even though we don't own the stock, we own the right to own the stock, which means that we could go out and sell short calls against this long call position. It would still be considered a covered position. So if we're paying 95.80 for that call, let's see, the natural's 95.80. Let's see if we can I'm going to leave that there because we're going to be adding a short call to this position. To create our diagonal spread, let's go to a shorter term contract. And how about we sell a contract with a high percentage likelihood of just expiring out of the money? Let's go for this 32 delta, only a 32% probability of that expiring in the money. That looks like that could bring in maybe 670, 685. What we're doing here is we'll have the right to buy shares at any time for the next couple of years for $300, but for the next 29 days, someone will have the right to buy shares from us for a higher price, $360. And this creates our diagonal spread. So I'm going to sell. Let's hold down our control key and click on the bid price to sell that 360. And let's make sure that that one matches just one contract. Buying the $300 17th of December 2027 call, selling the $360 17th of October 2025 call. So this is known as a diagonal spread because our two contracts are separated by price. We have one at 300, one at 360, and time. One for 2027 and one for 2027 and one for 2025. So if we were to draw a line connecting price and time, at least in my eyes, it creates kind of a diagonal spread. And for some people, they call this the poor man's covered call because instead of spending $341 and collecting maybe a $6-ish premium, we've spent $93 and looking to collect a $6-ish premium. So let's unlock this for a moment. Looks like that's going to cost us somewhere in the neighborhood of $86. Let's say we're willing to spend more than that to net into this trade. How about we go to $86.75, right in the middle? Close enough. Let's click confirm and send. Buying this diagonal, we're trying to get in for a net of $86.75 between buying the long and selling the short. There is a commission to pay on both the long and the short side, bringing our total minimum cost or maximum cost here, $86.76.30. Let's send this order off. See if we can get filled. Yeah, looks like we're offering to pay a higher debit than the current mark. I think there's a good chance this will fill pretty quickly. But as we're waiting on that, I want to say, guys, we have accomplished what we set out to do today. I wanted to talk through the pros and the cons of using a long call option as sort of a stock replacement strategy. Oh, looks like we filled for 85.45. Perfect. Yeah, I've outlined 3 potential advantages and 3 potential disadvantages to that sort of an approach. If you thought of some more, go ahead and leave a comment and let me know what, Cameron, you obviously missed this. You didn't talk about this. Yes, there are other potential considerations. That's why with options, the trader should get a good round understanding of the strategy before entering these. All right, guys, thanks for giving me your time today. Time for me to let you go. Brent, thanks for helping out in chat. Everybody, make sure that you're taking full advantage of all of the educational resources made available to you by Schwab. First of all, if you haven't subscribed to our Trader Talks channel on YouTube, please do that now. It doesn't cost anything, and it only takes a second to do it. You just go down in the lower right-hand corner, click on the subscribe button, or go down below the video stream and click on subscribe. But our Trader Talks channel is where we house our previous webcasts right here under our playlists, and they're organized by topic, by series. So if I were to go to playlists, and if I scroll down toward the bottom, we can find this full series for long verticals and diagonals. There's that full playlist. We can see previous trades, previous topics. Also, make sure that you're following Brent and me on X. You can find Brent on X at Brent Moore CS. You can find me, as I've already demonstrated, at Cameron May CS. So there's my handle. And we can have discussions about things like, what is this pattern known as an island gap reversal, and what might it imply for a trader? If you reply to one of my posts, I try to reply right back to you. Best place to connect with me in between these live streams. All right. Hey, thank you to everybody that's already clicked the thumbs up or the like button. That's always appreciated. That's like applause to your presenter. It also gives a boost to the presenter in the YouTube algorithm. So I hope you have the habit whenever you watch one of our webcasts. If you enjoyed the webcast, click that like button. That only takes a second, but it has a significant impact. So thank you for doing that. Looks like 62 have already clicked the like button out of 135 currently watching. That's awesome. Thank you. All right, everybody. I will see you maybe in tomorrow's webcast. I have something new every day of the week. I'll also look for you just next Thursday for another discussion of long verticals and diagonals. And finally, I'll look for you next. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.